name is Griffin Ryan. I'm going to be presenting today on Subsidized Greed, my honors project over how quantitative easing has encouraged risky investment practices on Wall Street. So kind of an overview of today's discussion. I'm going to start out by talking about kind of my personal background and interest and how I got into the topic. And then I'm going to move into white picket fences, which kind of discusses how the American dream became infatuated with home ownership. Moving on from there, I want to go into how the Federal Reserve came about and how they reacted during the Great Depression and some of the contractionary policies that they enacted that possibly might have elongated the Depression. And then I'm going to talk about the New Deal and that fiscal policy aspect to kind of get that juxtaposition between monetary policy and fiscal policy. From there, I'm going to jump forward a bit into 2008 and the American dream and how they kind of all came crashing down. I will fill in the gaps a bit and kind of reference a few other periods of economic turmoil before the 2008 recession that played a role, I think, in exacerbating its effects. From there, we'll get into the Federal Reserve's response, which is quantitative easing, and how that worked without much congressional oversight or regulation at the time because of the amount of gridlock that was there. And then finally, I'm going to wrap up with a quick analysis of the pandemic and kind of the rage we've kind of seen grown politically amongst the electorate as it relates to the financial world in America. So kicking things off a bit, kind of getting into my personal background and interest, I've always been a little bit enamored with politics. I really do. Love the study of it. I like hearing why people lived or why they did the things they did. It makes for a very interesting conversation, I believe. And so I came here as a political science major. The summer of my freshman year, I interned for Senator Ben Sasse, and I had a lot of constituency calls, and a lot of it did deal with economics, and so I wanted to figure out more about that, so I ended up picking up a business major with a concentration in economics. And from there, I've been a government relations intern for Tenascus since. And a really big, important piece of media that has really influenced my decision to really delve into this topic was The Big Short, the book and movie. Both are excellent in breaking down the intricacies of the 2008 financial crisis and democratizing the financial language behind that, making it easier for people to understand as well. And I also do like a challenge, and the Federal Reserve is extremely difficult to understand, and so I've spent the last couple of years kind of really getting into it, and then since August I've been really digging into the weeds and how it kind of came about. So first off, I want to talk about picket fences and the American dream. So home ownership has been synonymous with the American dream since around the 1930s and the New Deal under FDR in the aftermath of the Great Depression and World War II. Throughout the 1920s, it was a very crazy period of time. The wealth gap between the richest Americans and the poor Americans grew substantially. There was a lot of corruption under the Warren G. Harding administration, and there was a huge stock market crash in 1929. Most of which was revolved around deregulation and a lot of cracks in the financial system. And we see this in the home ownership as well. So before the New Deal, roughly 45% to 48% of Americans were homeowners, but the mortgages were weird, extremely weird. They were often 5 to 10 years, and the down payments were often 30%, if not more. And a lot of times these were just interest-based mortgages, so you would pay off your interest and that was it. And at the end of the term, at the maturity rate of the mortgage, you would have to pay the entire principal, or you'd have to renegotiate with your lender to get different terms for the loan. And we also at the time did have the gold standard in effect too, which proved to be very inadequate as the Fed was not able to respond to the ebbs and flows and changes in demand for US dollars. And it did kind of provide a juxtaposition between fiscal policy and monetary policy at the time as well. I think a good example of this is the Homeowners Loan Corporation, which was created to set the precedent for long-term mortgages in addition to payment plans that included the original principal, accrued interest, and taxes. And I think that was a really good program at the time, and it really did drive up home ownership rates as well. And when we're talking about monetary policy and the juxtaposition part, the Fed does a lot in influencing interest rates through both the federal funds rate and the discount rate, both of which I will talk about here in a moment. But at the time as well, with the rampant refinancing occurring throughout the 1920s, this was a really big precursor to setting up the Depression. And yeah, so moving forward from here, I actually was able to find a mortgage. This is from 1922, and if you look right here, it begins. Doesn't work. Okay. So in 1922 of July, this gentleman signed a a mortgage agreement with this bank at a rate of interest at 10%, and that was due back on January 1st, 1923. So that's basically a 6-month mortgage plan right here for $2,500. You can see at the bottom the collateral he put up as well. So his entire flock of goats, and also his entire flock of sheep as well. I actually went back and kind of traced this guy's mortgage history. He did quite a lot of business, so he was a very well-conceived borrowee. So this was not his first mortgage. But kind of moving forward here, and setting the standards in place for what brought about the creation of the Federal Reserve. We had the panic in 1907, and at the time there was a lot of what we call trading on margin or trading on credits. And so we see with call loans, and these loans, which did not require collateral, were offered to Wall Street traders by trust companies, and they were often expected to pay back the mortgage, or not the mortgage, sorry, the call loan by the end of the day. And with no central body to set interest rates in place, they could set these interest rates at whatever they wanted. And so on October 24th, 1907, those rates jumped to 100%, and with all that credit in the market, no one was able to pay that back, and so the entire system kind of fell apart overnight. And without a central banking institution in place, they had to oftentimes, the U.S. government had to go in and get bailed out by billionaires like J.P. Morgan. So it built this really uncomfortable relationship between U.S. capital and the U.S. government. And so both the Wall Street elites and the U.S. government thought that the system was not good at all. It created an unhealthy relationship. And so Senator Nelson Aldrich, who sat on the Senate Finance Committee, had a secret meeting with the Wall Street elite, including J.P. Morgan, to put a system in place to create a central bank. And so this was heavily influenced by the creation of the European central banks as well. So the Bank of London was a huge example of this. And so this was passed into law in 1913 with the Federal Reserve Act. But the system didn't change overnight at the time either, as the act required that central banks do hold 40% of their overall currency. It's issued in gold, so they had a 40% reserve requirement in gold. And this meant that the amount of currency that the Fed was allowed to circulate and its ultimate value was still tied to the gold standard. This alone vastly limited the toolkit available to the Fed, as dollars had to be converted to gold at the fixed price of $20.67 per ounce. And although the Federal Reserve still had the power to raise and lower interest rates, these reserves were kept so that the Fed could pay back mature securities that had purchased on the open market by banks and other financial institutions. And when the Fed needed to drive up its supply of free excess gold, it would raise rates, which in turn would incentivize consumers to deposit funds in American banks and further encourage foreign investment. And so this basically meant that the public was putting their personal gold from their households into the banking system, which in turn increased the excess free gold available to the Federal Reserve, its district banks, and its member banks as well. And this is where we also see the introduction of the discount rate, which is not as important today as it was back in the 1920s and 30s. But these are loans made with the Federal Reserve itself between banks, so banks will go to the Fed, get a loan from them, and then they will use that to circulate throughout the financial system. But these loans have to be backed by collateral, which proved kind of difficult during the 1930s and the Great Depression. So this is where we see the creation of the federal funds rate in the 1920s as well. And this is just the rate that the Fed sets where it's the term of interest that banks pay to borrow from other banks. This is typically referred to as the overnight rates. It's pretty fluid, it changes pretty frequently. And this is kind of what we think about when the Federal Reserve comes out and they're talking about interest rate hikes or interest rate declines and things like that. It's typically in reference to the federal funds rates. And this is actually where the bankers all met. It's the Jekyll Island Club in Georgia, pretty exclusive country club, but they sat here for a week, if not longer. It might have been 2 weeks. But they sat here to put together a plan to create the central bank. And yeah, at the time though, there was a lot of media scrutiny, so they had to do this very secretly as well. So what they eventually created was the Federal Reserve Act in 1913. However, this did not prove to be the most perfect system either. There was a huge explosion of credit trading on Wall Street again in the 1920s with lots of rampant speculation. And although the Fed had handled one recession in 1920 and 1921, where the unemployment rate rose from 4% to 12%, and the price index doubled 37%, the outbreak of the recession is largely at the feet of the Fed itself because of the newly founded central bank. It depleted many of its excess gold reserves throughout World War I. which was exacerbated by the ending of the gold export embargo in 1919, and they had to raise their discount rates in 1919 and 1920 so that they could get their excess gold reserves back up again, because a lot of that had flown out throughout the war. And then we also saw the emergence of trading on margin, which again is pretty similar to call loans, but this skyrocketed to about 20% of all loans, or all trades on Wall Street being made through these margin credit loans. So with almost a quarter of all these loans being made, there's a lot of excess production going on. And again, there was a huge wedge driven between the poorest Americans and the richest Americans. So with all this excess supply in the market and no one to buy it, everything kind of came tumbling down and the market came back to earth. And over the course of just 2 days, the Dow dropped a total of 23.05%. And the Depression began with 3 separate banking crises from 1929 to 1930. So this is basically just runs on the banks where people want their deposits back, people just want cash, they want liquidity. But the banks are not able to provide that because they were using deposits to also engage in investments too. So there was no separation between commercial banking and investment banking. So we also see a huge flight of foreign capital from Europe into the United States as well, which causes the gold reserve plunge. Gold reserves held by the Fed to plunge by $725 million in 1931. So the Fed needed to get more gold reserves, so they raised the discount rate, which made the crisis worse. And at the time, one of the largest issues here is that there was no robust system for open market operations. The Fed could not go in and inject capital or liquidity via buying securities like treasury bonds and things like that. That wasn't a thing. The Federal Open Market Committee was not created yet. So the Fed's toolkit was pretty limited, and so speculators also started buying gold. And by 1933, this was just a disaster. President Hoover, who was the president at the time, had a very classical view of what government should be in a society, and so he wanted to just let the markets play out, let the situation play out, maybe see what happens, and eventually this all goes to the bottom. It's terrible. And FDR and the Democrats went big in 1933 on this huge mantra that he called the New Deal, which is a recreation of the social contract between U.S. citizens and their governments. And so they went huge in 1933, and he declares a banking holiday, which lasted for quite a few days, where all economic activity in the United States was basically halted. And so you can kind of see here this massive bull run the market had in the 1920s all the way to 1929, and you can just see how devastating that tumble back down to earth is, and how awful this was for normal everyday people. So definitely not a fun time to be around. And this was also at the end of World War I as well, so there was a lot of politics going on with that, with the veterans wanting their checks from the government, so a lot of politics playing out at the time. But eventually we do get the New Deal. So in his first year as president, FDR signed the Banking Act of 1933 into law, and this created the Glass-Steagall Act, which basically separated commercial and investment banking. And it also created the Federal Open Market Committee, so the Federal Reserve could finally go into the market and buy securities to inject liquidity and cash for people that way. And we also finally see the introduction of the FDIC, or the Federal Depository Insurance Corporation. So for the first time, the government stepped in and they said, we don't want bank runs, we want as much stability as possible throughout this time. And so they agreed to insure loans. Nowadays it's up to $250,000. I'm not sure what it was back then, although obviously it was not $250,000. But yes, so this really did restore stability back into the banking sector. And then we also see the creation and the further utilization of the Reconstruction Finance Corporation, which was created under Hoover, but this basically mostly just provided liquidity to financial institutions with no teeth attached. So a lot of these banks and institutions were hoarding cash at the time. Hoover didn't want to step in further, but FDR comes into power, and he's able to insulate Jesse H. Jones, who was a Texas billionaire at the time, but he had garnered his wealth by participating in credit schemes and things like that to build his empire in Houston. He's one of the most popular figures in Houston, like historically speaking. He was very well beloved. But throughout his tenure at the RFC, he is able to buy bank stock, effectively becoming a partial owner of a wide range of America's banks, and basically by becoming a shareholder of the banks, he's able to force the banks into providing liquidity to and loans to everyday Americans who need it for farming and things like that, among other things. And it allowed banks to be held accountable because they are taking government lines of credit as well. So there wasn't that accountability factor in this as well. And they also bought gold beginning in October of 1933 at increasingly higher rates to lower the value of the dollar and its relationship to foreign currencies and the commodity of gold itself. So we kind of see this rollback of the gold standard throughout this period of time. And the ultimate goal was to prop up the value of agricultural commodities by depreciating the value of the dollar, which was eventually accomplished by the latter half in the 1930s. So as you can kind of see here, we'll take a look at some graphs. We do have the GDP and employment rates throughout the time. So I will be the first to say that I do not think the New Deal alone was able to restore stability in the markets. I think that came from World War II and the amount of production that was going on. And I think that was really what brought unemployment back down to earth. But I do think the financial regulations that it put in place were extremely palpable and led to the decades of the golden era of the United States between World War II and the 1970s that were really stable and had insane returns because there were guardrails in place to stop speculation and to let the market develop in a healthy way, not a warped way we kind of see back in the 1920s and in today's world. So, now looking at the unraveling of the New Deal and its legacy. So, for the first time in history, commercial banks were finally separated from the investment world. The SEC, or the Securities and Exchange Commission, was created to police Wall Street. Commodity manipulation was outlawed, and those dealing in futures brokering were required to register with the federal government and to keep detailed records of their work. Furthermore, the Federal Reserve was finally unshackled from metallic monetary policy. This was mostly just domestically because we did have a gold standard in place. Internationally, so that we could trade foreign currencies back and forth with other countries, and those foreign currencies could be converted to dollars via the gold standard. So that was kept around until Nixon's presidency. And also we see this huge spike in home ownership too. So we see the HOLC, which I brought up earlier. By 1954 it was defunct, but it was huge in providing stability to Americans. I think the stat was 1 in 5 Americans, homeowners at the time who were struggling, were able to be bailed out by the HOLC and were able to refinance their mortgage to get a more acceptable rate, a more fair interest rate with better terms. So I think the HOLC played a big role in producing a really stable housing market throughout the 1940s and at the end of World War II. But by the time it gets to the 1970s, at this point in time, the GDP has grown from $223 billion in 1945 to $1.7 trillion in 1975, with the U.S. having a 35% share of global industrial trade. But we do get this really bad period of stagflation throughout the 1970s. And stagflation is just high inflation and high unemployment combined. So it creates this really stagnant, very gross market that's hard to get out of. And during the worst inflationary periods, it actually shot to 13.5% inflation in 1982. So just very dire at the time. And Jimmy Carter was president, and his Fed chair at the time was Arthur Burns. And Burns had this very classical view where he believed that high inflation for a long period of time would eventually lead to low unemployment. This was kind of a misnomer brought on by the Phillips curve, which I won't explain all the time. But basically, with this in mind, he believed that, yeah, long-term rates of high inflation would bring down unemployment. This was not true. It was more true in the short term, but definitely not in the long term. So before Jimmy Carter leaves office, he selects Paul Volcker to be his Fed chair. And Volcker is a different animal in this sense. He goes in, he cranks interest rates up to, I believe at one point in time in 1982, 20%. So the Fed funds rate is cranked to 20% because he knows that it's a necessity to keep rates high so that we can bring inflation back down. He doesn't buckle. He's pressured by both Jimmy Carter and Reagan to bring rates down, but he holds the line, and eventually inflation smooths out. But this is the era in the 80s where we see just rampant deregulation. So looking first at securitization, which is really linked with the Glass-Steagall Act as well. The 1980s saw the widespread adoption of mortgage-backed securities. And at the beginning, mortgage-backed securities were pretty simple instruments. They were actually created by two of the quasi-governmental government agencies, Freddie Mac and Fannie Mae, but these were really stable securities at the time, and they were really utilized to provide more liquidity for originators. So loan originators had a lot of debt on their books, and so they needed to free up some of that debt so they could issue out more loans to a lot of stable family homes. And so these were mortgage-backed securities that were created for that purpose, but eventually the private market catches on, and we see this widespread adoption of these more exotic mortgage-backed securities with very poor credit ratings. And then, they first were able to, the private sector first bought into these more safe mortgage-backed securities and collateral mortgage obligations. But eventually, the Federal Reserve Board of Governors amended Regulation T of their regulatory code, which allowed broker-dealers to use pass-through mortgage-backed securities as collateral for margin trading. And eventually the FDIC gets involved too, and they're the first government agency to really make a move by ruling that insured banks outside of the Federal Reserve System, which a lot of times were state-chartered banks, could institute or procure subsidiaries that were involved in securities trading. So we kind of do begin to see this meshing of commercial banking with investment banking again. And we also see the bureaucratic rollback of the Glass-Steagall Act. It would not be pulled back until 1999 under President Clinton, but Reagan's bureaucratic appointed officials did played a really big role in deregulating the investment world at the time. And they also did pass the Alternative Mortgage Transactions Parity Act in 1982, and this allowed mortgage classifications like adjustable rate mortgages to become less regulated and more freely available. In the same year, the maximum loan-to-value ratio and aggregate limits on a real mortgage estate, which was in place to protect borrowers, were removed for national banks involved in mortgage lending. And this allowed for the subprime mortgage market to take off. And subprime mortgages really just refer to a particular type of borrower who's getting a mortgage. And these types of borrowers have one of the more following attributes, that being poor credit score, limited credit history, lack of assets, extreme levels of debt, and a history of defaulting on debts as well. So the floodgates are open at this point, but it's not really brought on until the 1990s, and you can kind of see here. So the blue for the agency residential mortgage-backed securities, that's your Freddie Macs and your Fannie Maes and your Ginnie Maes as well. So the quasi-governmental agencies are taking these on, but the majority of these are all safe, relatively very safe assets. They aren't the subprime mortgages we see in the private sector in the red. The majority of mortgage-backed securities bought by the private sector by the late 90s and mid-2000s were mostly subprime because they had higher yields and bigger returns. So we can kind of see that spike again as well in the commercial mortgage-backed security markets as well. And so this leads us into 2008 in the American dream, kind of coming crashing down. So by the 1990s, mortgage-backed securities have become one of the hottest commodities in the market. In 2000 alone, $130 billion worth of subprime loans were issued, and by 2005, this skyrockets to $625 billion, $505 billion of which were bundled together in these collateral debt obligations and collateral mortgage obligations. And I'll kind of go through that quickly, right? So we do have a collateral pool, which is all the assets pooled together, like loans or securities, and they're pledged as a security for a debt or financial obligation. And then those are all pooled together for investors to buy. So at the bottom we have the very lowly rated B tier, or B rated, credit rated mortgages. Up from there we have the triple B rated mortgages and the BAA mortgages as well, also called the mezzanine. It's the middle part. Mezzanine is French for middle, just an FYI. So it's the middle part of the CDO and the CMO, and then we also have the top A rated mortgages as well. If you've seen the movie The Big Short, the investors go in and they short the mezzanine or the middle tier of the mortgage market. So those are more slightly subprime. They might be subprime with a fixed interest rate or a longer fixed interest rate before it converts into an adjustable rate. They can crank the rate up. But basically, they believe that in the movie, they believe that the triple Bs are going to, or the triple Bs are going to fall just as much as the more poorly rated class of mortgages as well. So they're able to short that and make money off of that. But then going back, banks do line their books with these. And at the time, there was a lot of collusion with the credit rating agencies as well. People weren't really understanding what they were buying. These were completely just subversions of investments, in my opinion. And so throughout this time, though, in the 90s, we see the festering of the dot-com bubble. The Federal Reserve at the time was keeping rates relatively low. But then we see a huge cash injection by the Fed in 1999 between September and December. They injected $194 billion worth of M3 money, or the broadest term that the Fed classifies money as. This is pretty much all money in the economy. But they're able to inject $194 billion because they're scared of what might happen if the Y2K disaster does blow up. It does not though, but the NASDAQ does, because it blows up. It goes up by 800% between 1995 and 2000. With all this new money in the economy, we see huge spikes in inflation, and the Fed has to raise rates. This spooks investors and angel investors, venture capital, and so they get cold feet and they start pulling out from their dot-com bubble ventures, and eventually that bubble burst. But funny enough, the San Jose, California, which is kind of like the mecca of all dot-com bubble companies, they would all go do business here, and they would set up their businesses here. Their real estate market still shot up by 59% between 2000 and 2005, and at their worst point, they had a unemployment rate of 9.2%. So I mean, it just doesn't make any sense, right? So we see this more growing investor in the subprime mortgages. And eventually, by 2006, home ownership rates peaked at 69.2%, the highest in history. But then we follow this up with 2007 with 2.2 million foreclosures. And by 2008, it's 2.3 million foreclosures, and we are officially in a liquidity crisis. It's also important to note here that the top percentile Americans saw a 22.83% increase in real income throughout this time as well. So quantitative easing, this is where the Fed kind of steps in, and they understand that they do need to go in and provide liquidity in the markets. So in November 2008, they began doing this, which is, again, quantitative easing is this combining of low interest rates with the purchase of long-term risky assets. They were in the market and buying mortgage-backed securities off the private books from these banks to provide liquidity in the markets. And their thought process was that banks would lend money at low interest rates, unemployment would drop, and wages would rise in tandem. But in reality, banks bought the same bonds as the Feds because they realized that investments were going to be safe. Unemployment rose to 9.9% and foreclosures continued. By 2010, the Fed had garnered $2.1 trillion in assets on their books from these banks, and quantitative easing round 2 begins. 2011, where they buy $600 billion worth of additional assets. And this is also where we see the rise of the Tea Party movements as well. And so we see this political backlash to what the Fed is doing, and the most palpable version of that is on the rates. So where's Congress in all of this? They passed the Dodd-Frank Act in 2010, which creates the Consumer Financial Protection Bureau, enacts stricter capital requirements, and prohibits banks from proprietary trading. But there's a lot of issues with it as well. There's endless loopholes, like they can get involved in spot commodities, which are pretty speculative. There's shadow banks. Actually, Lehman Brothers and Bear Stearns are technically considered shadow banks. These are basically hedge funds and investment banks, and these aren't really regulated by Dodd-Frank at all. And in 2018, it was watered down as capital requirements for testing the legitimacy of the banks and stress testing the banks is lowered or raised. So less banks have to be involved with stress testing as well. And the market becomes really bullish. There's moderate growth throughout 2010 to 2012, but then we also see the Fed buying $40 billion more assets, and another round of quantitative easing. And the Fed funds rate is below 1% throughout this time period too. And by 2013, the Dow shoots up by 26.5%, and when Bernanke signals that he wants to start cutting rates and to free up the assets holdings of the Fed, there's a taper tantrum, and the markets react pretty negatively. So at this time as well, we see the share of labor share of corporate income falling. By 2008, it's at 83.6%. By October 2014, it's at 75%, and by October 2024, it's at 71%. And the main issue here is that because the Fed can't directly direct money to wallets, they aren't able to really provide stability in the way that they want to. And there's a lot of gridlock in Congress. They can't get anything passed to properly regulate these banks further. And we see this kind of this rage kind of build up into Donald Trump, where he goes in and he comes in with this big populist mandate, but for him, his biggest accomplishment in his first term was the passing of the Tax Cuts and Jobs Act, which ironically was his worst day in office approval rating-wise, beating out January 6th. But this also provides a sugar high for the markets, and so again, we see this big bubble festering of overvalued stock prices and everything. And then we get COVID-19, and the Fed steps it up a notch. They buy $700 billion new assets, including junk bonds or really poor corporate bonds. So like I know Delta Airlines has a lot of debt, and they were buying bonds like that. So conclusions and recommendations, I believe that in America we should really be focusing more on improving companies versus growing their stock prices. The Consumer Financial Protection Bureau, which has returned billions to consumers, is now under threat by the current administration. It's becoming politicized. There's a lot of claims being thrown around that they are playing a role in debanking people. That's false. They are actually making sure that people can be banked regardless of their politics. And that's being targeted by Mark Zuckerberg and Elon Musk, who want to see it taken apart because they're investigating them. And I also want to see a restored to the New Deal financial regulations, putting back into place the Glass-Steagall Act. I think Powell should not lower rates and withstand political pressure just like Volcker did. There needs to be capital requirements for shadow banks. And I also believe that moral hazard is a bigger threat to capitalism than regulations, just like FDR did believe as well, as he did see rates for party affiliation for socialist parties and communist parties go up throughout his tenure. And I also believe Congress needs to revive its relevancy and actually do its job.